the internals of the market is very different than the headline. So when you take a look at the headline of the market, that's a very, very different story about what's happening internally in the market. So here's what you need to know before the bell this morning. We wrote on Tuesday an article, it's on the website now, realinvestmentadvice.com, talking about S&P 5,000. Big, round, psychological number. Markets are going to get there. They're going to gravitate to that. Yesterday, the market got to 4,999.53. Missed it by 47 bips yesterday of getting to 5,000. This morning, futures are looking to open a smidge weaker. I suspect we're going to try to make that attempt to 5,000 probably today, if not tomorrow. But we did close at 4,981 yesterday. So, I mean, you're right. We're right there. We're within 5 points of an all-time high. So, the market set an all-time high yesterday, pushing up there. But here's the interesting part. So yes, markets are back to overbought. We're still in a buy signal. Again, so from the headline that we're looking at, absolutely nothing wrong with this. Problem is when you look at the internals. The internals are weakening. The number of stocks above their 50-day moving average are turning lower. The number of stocks above their 200-day moving average has turned lower. So what we're seeing is a deterioration of participation within the market, even though the market's going up. And again, why is the market going up? We've talked about this, before, but this is those top 10 stocks that are dragging about 35% of these passive inflows. So as the market's going up, everybody's throwing money into the S&P 500 index ETF, and that's fueling these top stocks, Meta, Facebook, Apple, Google, etc., right? And that's continuing to just draft the market higher. The problem is that the rest of the market is selling off at that same time. And so that internal deviation is certainly something worth paying attention to, and certainly suggests that the market is substantially weaker than what the headline suggests. And again, you take a look at what's happened, and we talked about this yesterday, but the gap in performance between the S&P 500 and the rest of the index, you start talking about the S&P 600 as example, small cap stocks. Small cap stocks have been vastly underperforming this year. They've actually been declining. Their return negative on a year-to-date basis. But again, we go back and look at small caps over just the last couple of years, and they have just done absolutely nothing at this point in terms of actually getting some traction. So again, when we take a look at the market, this has been a market driven by a relatively narrow breadth of stocks that are moving this market higher. Again, doesn't mean anything, today, right? But you have a lot of bullish exuberance. If you take a look at investor sentiment, you take a look at investor allocations, they're very, very bullish, but yet that bullishness is underlined by this very weak internal mix that we have going in the market. So it suggests that at some point there's going to be a give back to that, and this type of mix of data where you have very strong bullish attitudes, a very narrow breadth, weakening participation, has typically been denoted near market peaks before intermediate term corrections. Now again, when we're talking about a correction, we're not talking about a crash. So don't go, Lance said the market's going to crash, get out of the market. I'm not saying that. What I am saying, though, is that a 5 to 10% correction to rectify some of these issues is becoming highly probable. And the question is only a function of timing and what triggers it. We're going to go into some of those triggers potentially today because it'll have a lot to do with the Federal Reserve. But there are some other risks on the horizon that could trigger a little bit of a reset in the market. But that's what you need to know before the bell this morning.